will is very important. The first thing you want to avoid is intestacy. Obviously, if you don't make a will, the intestacy provisions obviously kick in. That can mean that obviously assets go to the wrong people, not intended, they can be less tax efficient, and that then leaves you with having to then, the executors or the administrators having to do something about that. So it puts them in a very awkward position. Having a will takes the uncertainty away, it allows you to plan, it allows you to direct assets to the right
and it
people.
can cover off silly things like funerals and things, can't it, as well, and people can do all that.
Guardianship of children, that kind of thing. So it's not just about the tax, but the tax part is very important.
And I think the important thing is people don't need to worry, do they? If they've made a will and then suddenly rules change, there's always a deed of variation. So if somebody's got a will, their family have the ability within 2 years of them passing away to do something called a deed of variation, which is take the will, and as long as everybody agrees, they can tweak it slightly. So if there's something clever that can be done for inheritance tax that perhaps wasn't thought about when the will was made, then they can always do that later, can't they? And it's just that, as you said, Vicky, intestacy just leaves people in such a horrible place, doesn't it? With so few choices, that there's not really time to be tax efficient then, is there?
Well, yeah, I mean, they can't deal with the assets straight away. They may be left with loans outstanding, that they have no access to the deceased funds. It can cause all sorts of issues that we really want to avoid. So the will is the first place to start.
And you're never too young, really, are you? You mentioned guardianship, so I think once you've got a family, you need to have a will, and then every few years you get it out the drawer, you have a look at it. And
as your circumstances change over your lifetime.
As your children get older and things, you change them, don't you?
Yeah, and you can make small changes through a codicil, or you can obviously scrap the will and start again, and have fresh thoughts. Obviously, things happen, marriage, divorce, that kind of thing. So
yeah. It was that simple, Vicky? If we can just give everything away and solve the problem. Unfortunately, there are rules to stop us doing that, aren't there? So, for example, if I gave my house away to my children but carried on living there, that gift would fail for inheritance tax unless I pay them a market rate rent. So it's very difficult to give certain assets away, especially if you still want to have use of them and not pay any inheritance tax.
And there is also, you've got to live, so you've got to have a maintained standard of living. Nobody's got a crystal ball, so you can't necessarily anticipate how long you're going to live, how much money you're going to need over that period of time. Although, there are lifetime gifts that you can make, you wouldn't want to, divest yourself of all assets. You'd want to keep a little bit back, obviously, for a rainy day and for your retirement and whatever else. So
when the car needs changing or
exactly,
whatever.
Yeah.
I mean, obviously you alluded to there are things we can do. So we can all give £3,000 away each year, and if we didn't do it last year, we've got that £3,000. We can do the £250 per donor sort of Christmas gifts, can't we?
Yeah, to grandchildren and things like that.
And then obviously we're talking about perhaps gifts from income. Yeah. So if somebody's got a good pension and things and they aren't managing to spend all their income, because as you get older you tend to spend less, then people can make gifts from their income, can't they, and give those away.
And that stops obviously your estate from growing, because unwanted income, all that is just adding into the cash pot, isn't it? So that's a really good way of maintaining a level rather than allowing that to grow even further. Also, you can make obviously gifts in excess of the £3,000 a year. They won't be immediately taxable. If you did die within 7 years of making those gifts, they would fall into your estate, and there would be something called taper relief on those. But survive 7 years, so the sooner you start to do that, if that's what you want to do, it does come outside your estate, so you can save inheritance tax that way.
It's a balance, isn't it? As you said right at the start, you don't want to give everything away and be living in the poorhouse, but you can start to give things away and use the 7 year.
I think is the answer.
You use surplus income, or you can use the 7 year clock, but you don't want to give everything away, do you?
No.
We've all got our £325,000 nil rate bands, so we could all leave £325,000 without paying any inheritance tax. If I leave all my estate to my spouse, there'll be no inheritance tax. but they'll also benefit from that limit as well, so they'll also have my £325,000. So that's the starting point, isn't it, of thinking we can leave without inheritance tax.
More recently, they've introduced a residence nil rate band on top of the nil rate band, so that's an extra £175,000. And that only applies if you are giving away your main residence down to lineal descendants, so that's obviously your children, your grandchildren. You can still gift away on the first death to your spouse, and then for them to obviously gift down to the next generation. So in all, between a couple, that adds up to the million. So that's a very, very lucrative exemption that you can take advantage of.
Then your pension, usually pensions are written in such a way as they aren't part of your estate for inheritance tax, so there are another good things why you recommend pensions as part of inheritance tax planning normally, because your pension pot is usually free of inheritance tax. And then obviously some people will take out insurance to pay inheritance tax, and if your life policy is written correctly and written what we call into trust, then that will normally be outside of your estate and not form part of your inheritance tax taxable estate. But that's worth checking, isn't it? Because that's something you've got an active step you've got to take with a policy, is making sure it's written into trust.
Yeah, a lot of the bigger providers do that as a matter of course, but it's always worth checking, because what you don't want is to think it is, and then your executors find out that actually it forms part of your estate unnecessarily, for the sake of signing a piece of paper. Obviously there's business relief, so that's another thing that you can take advantage of. If you're a business owner, you can obviously, you have assets within that business, or you might have a shareholding in a company that's a trading company. That will obviously get relief. So providing you're still in business at the date of death, and obviously that is a proviso, there's quite a valuable relief, because a lot of your wealth may be within that business. So that does give you quite a lot of scope.
And then obviously there's the sister relief, as we call it, to business relief, which is agricultural relief, which is obviously aimed, as the name says, at agricultural assets. So usually for farmers, we say farmers die with the boots on, because they want to make sure they claim their agricultural relief. It's very complicated, it's especially complicated for things like farmhouses and for leased land. So it's definitely a relief you need to take advice on. But generally, there is a relief available for agricultural assets, which is agricultural relief.
And obviously, you don't necessarily have to be farming at the date of death. If you have, do happen to be ill or have retired, you can still get a measure of relief. It's just not as good as if you're actually actively farming. So usually restricted just to the land value, and there are some further obviously considerations in order to obtain that relief. Always good to check with your accountant. You're never too young. It's more to do with your assets and your wealth. I think you'll agree with me here, Sarah.
Yeah, I think as soon as somebody starts to accumulate some wealth, it doesn't matter how young they are, they need to start thinking about their inheritance tax, don't they, Vicky? And doing a bit of a calculation just to summarise what that point is and what that number is. And some people will calculate that number and be content, and that's all they need to know, and they'll have enough in the bank and know that the family can pay the inheritance tax. For some people, they need to plan, and they don't like the fact that there's inheritance tax, so they start to take steps then, perhaps making a trust. A trust's a common one, isn't it, Vicky?
Yeah.
We come across of people putting assets into. Now, trusts come with their own rules and regulations and tax things, but they are a good way, and because they last over 100 years, they can be a starting point of inheritance tax, can't they?
Brilliant for skipping generations. So obviously as people get older, but obviously not too old, it's great for them to obviously do trusts in favour of family members further down the chain. So and that is a really good way of divesting themselves of assets within certain limits.
And then there are products as well, aren't there? People can make investments, referring back to business relief. There are investments that sort of try to piggyback on that. Again, can be a quick way of reducing your inheritance tax within sort of a couple of years rather than the traditional 7.
Yeah, and those don't necessarily require you yourself to be in business. You're investing in a business. So that can be quite useful for people that aren't actively in business on their own account. So certainly the wealthy do tap into those products.